Welcome, everybody, to another Wealthy podcast. This is episode 2. We've got Evan Lucas here. Mate, it is good to have you on the show. It's been a while since our last catch up.
Mate, it has been a while. Congratulations to you before I go any further. Well done on your new book. I think it's fantastic. I know it's not out there yet for those of you listening, but I am super excited for you. Dom and I have a bit of a personal connection here, obviously doing our same publisher for our book and having a book out so close. So from my perspective, mate, congratulations. It's great to be back here and having a chat to you. I love sitting here, just having a massive chinwag about markets, where things are going. So looking forward to this. Let's dive right in.
Mate, it's been a little while, and massive congratulations to you too. That book over in the corner, Mind Over Money. I haven't had the pleasure of reading it yet, so I'm hoping you're going to send one to my house. In fact, I'll go buy 4 copies instead.
No. I'll send you a signed copy. How about that? If you,
And look, Evan, I really like catching up with you because I feel like you have a very good way of looking at the market and bringing it back down to earth. We're now into February. Last year was all sorts of chaotic. For myself personally, having a 1-year-old baby now, and also just the market, we've had eight interest rate rises. Is that right?
Nine.
So the last one was just not that long ago. I suppose the first question I've got for you is, what's your read on the market? Like, what's your cap on how things have gone after 9 rate rises, and do you think we're going to see many more?
So first, I'll answer the last part of that question first, which is yes, I do. That is a given. They've told us that they're going to raise rates again. The probability looks like there'll be 11 by the time they're finished. And I think you probably make the argument that there'll be 11 in a row, unfortunately, with regards to how it is, and then they'll assess how much sort of tightening and how much, inverted commas, their word is, squeeze is going on. The catch to that is this. I think the argument that everybody's having at the moment is about why rates are rising, how much pain and suffering it's causing, and blah blah blah. I think what's being missed in this debate is they are not really prosecuting the issue of inflation. And what I mean by prosecuting that is that I don't think they're fully explaining, without using inverted commas, boffin speak, why inflation is so, in their words, corrosive, detrimental. And why I say that is that do it, as you said, bring it back down to earth and just do back of the calculation of reasoning for it. So why I say that is, we and I talk about, in what we do, compound interest, capital growth, the appreciation of the assets you have. Let's even bring that back even further to what inflation talks about with just $1. And why I say $1, the RBA's mandate is to keep inflation or price stability between 2 and 3%. And that, it seems to be about where purchasing power can continue to grow with increases in price. So at that sort of level, $1 today, in 5 years' time at 2% is about $1.10. At 3%, it's $1.13. If it was to run at the level it currently is, which is above 7%, if it was to run for 5 years, $1 today, you're going to need $1.40 in 5 years' time. So you're talking about a 21 to 23 cent difference in 5 years. That is incredible inflation. And that is the issue with that, is that means for every dollar you have today, you've almost got to basically get 40% more of it in 5 years' time. And you go and ask your boss to give yourself a 40% increase in pay over a 5-year period. It's this which I think is being missed in the debate. When you start to put it in that perspective about why they need to slow price rises down, and why the only lever they have to do that is to take money out of the economy by raising rates. So you having less money in your pocket to go and spend, to have to concentrate on, basically servicing an asset, being a home. That is what they're trying to do. And therefore it slows down demand, slows inflation, and therefore slows that problem I just spoke about, which is the impact on purchasing power. So from my perspective, the markets at the moment, particularly the equity markets, I think haven't fully priced that factor in. I don't think they fully slowed it down. The results you're getting from earnings season is telling you it's coming. The behavior is coming. The behavior change is coming. People are fully now aware of it. I mean, it used to be the cab argument, isn't it, Dom? But what I'm actually now finding, it's just, I call it the cafe comment. You and I can go and sit in a cafe wherever we are in Sydney, Melbourne, Brisbane, and Adelaide, and just basically shut up, and you will hear this discussion going on around you. Like, everyone is talking about it. for good reason, because the cost of living is up and they know that the cost of servicing what they do is up. And that to me means that it's coming. People are starting to have it front and center, this inflation psychology, as the RBA calls it. It's here. It's finally here. So from my perspective, I do think that there's going to be a bit of a slowdown coming. The narrow path, whatever you want to call it, I think is interesting. But I think there will be a change in people's spending habits. That also means that there will be a change in how markets operate. There will be a change, particularly in property. And I think it's already been seen. Property, I think, has actually done the fall. I don't think it's going to go any further. And I'm sure I've got to ask you now that question. How do you see the markets going with property? Because from what I see is supplies coming out. You are starting to see definite changes in the way of behavior of sellers, particularly, and there is signs that it's bottoming out. Is that how you evaluate property at the moment, Dom? Because I know this is your world. How are you seeing the change that's going on in property in the last couple of months?
Well, I want to answer that question, but first I want to say something about what you had just mentioned, because you unpacked a lot of really interesting things. The first being around the language around inflation and interest rates and how it hasn't been brought down to earth, and how you've just said it. You need 40% more money from your boss in order for you to live your life.
In 5 years' time from today.
5 years' time, correct.
Yeah.
And what was also interesting is just some of the comments around the RBA, kind of people saying, well, the banks are making all of this money. Banks are the criminals and they're the crooks. Why aren't you doing something about the banks? And their comments were that we are fortunate to have a strong and healthy banking system. Correct. Because having that healthy banking system basically underwrites all the assets in Australia, and a poor performing banking system leads to, the
crashes.
GFC, massive crashes.
Yeah. So, I mean, if we want to go and have a Babcock and Brown scenario here in Australia, or go and have a Lehman Brothers, by all means, let's not have profitable banks and start to impose restrictions and caps and squeeze them on what they can do. Their ability to absorb what's coming is because they're profitable. I mean, as CBA has just pointed out, they are saying they've just had the peak and they're about to experience it. I mean, I don't know about you, but what caught me about CBA is that they're actually starting to talk, like inverted commas, a corporate citizen. They want to actually help their clients through this period, whether that is, offering discounts on the loans they have, talking to them about interest-only loans. And I know you and I will have a bit of a different opinion on that, because I'm not a massive fan of interest-only loans if you can avoid it, because obviously you need to try and pay your principal off as fast as you can. It means you own the asset faster, but they are already talking about slightly sacrificing cash profit to make sure they can get their clients through it. I mean, again, you hear what we're talking about in the AFR today. Their business bank is already basically provisioning like no tomorrow for the pain they expect to come from the business side as well. So I agree with you that bank bashing is so easy. I mean, you and I know this well. I mean, I could sit there and go through since 2010. Bank bashing, I reckon, comes up at least every 18 months in a political sense, one way or the other. Doesn't matter which side of politics either. Like, I'm not sitting here saying this is a left-wing thing or a right-wing thing. Both sides love it because it's an easy
target. It's an easy target. But, I think that you're right. Even since COVID, the banks have shown a responsibleness for the people that they're looking after, because they have a vested interest in the success of the asset they're lending against. And this is something that people don't pay attention to. They want you to succeed. They want your property to appreciate in value, because they've got a risk that if your property goes down and you sell it for less than what the loan is, they're at risk.
Yep.
But back to your question about the property market, where I see it going is everybody's waiting for a tremendous crash. I'm all over all social media and I get all sorts of funny comments about interest rates are going to hit 18% again. And, we haven't seen
don't you love them?
Yeah.
And we haven't, keep going.
We haven't seen a property market crash just yet. I just don't see the market dropping too much more. And I don't really think it's going to go below pre-pandemic levels. And the reason why is a few things. One, the average borrower in Australia has too much money sitting in their offset account. So there are thoughts of some people being in negative equity, but that's very rare. Two, there are a lot of people out there that are sitting in very strong equity positions and don't need to sell. They don't have to sell. So why would I sell? We've seen that the property market during this time where there's been a bit of a decline in the price, the volumes of property have then come off. So there's been less sellers in the market. The other side of thing as well of this as well is, as you mentioned, that there's supply issues. Build costs are extraordinary. There's less homes coming out of the ground. The HIA put out a report just the other day that we're 50% less stock coming onto the market than we were 12 months ago. So there's not a lot of stock coming out of the ground. Approval ratings are relatively low. But then on top of all this, we're near pre-pandemic levels for migration. So there's hundreds of thousands of people coming into the country that all need places to live. We've also got tourism coming back, and China said to all their students, get back to Australia. You need a place to live if you're going to finish this degree, and it's going to be recognized. So interest rates are one thing that puts pressure on demand and it puts it all down, but there's supply. There's only so much supply being created, and there's a hell of a lot of people coming into the country. So,
you know, I'm with you.
Yeah, even if homeowners go down in price, there's still going to be a very strong investment market purely because rents keep on going up.
Yeah, and I'm with you. And it is, you've just, like, my argument is simple supply and demand economics. Not only that, you've also hit something that I always remember from my behavioral finance stuff background and learning that at uni, is that property is the only market around where people will sit on supply. Like, there's a psychological thing that, again, if you're not going to sell your own personal home if you think you're not going to get the price that you think it's worth. So you're living in it, you're enjoying it, you're getting the benefit of it in another way rather than from an actual financial transactional point of view. So that's the other thing that happens, is that you're right, that all of a sudden supply will dry out because the owner of that individual equity property position will not be forced to sell. And even if there's a handful, and by a handful, there might be several thousand that do go into negative equity. It's so very small in terms of that space. And even with what's being talked about, the other thing I think is sometimes lost in this debate, and you're much better at this than me, is that I don't believe there's a true Australian market. There's a Sydney market, there's a Melbourne market, there's an inner Sydney and an outer Sydney, an inner Melbourne and outer Melbourne, Adelaide, Brisbane, same thing. And then you've got the regions. And it's, I mean, you only have to look again on the papers are loving this again. There's already, signs that in the areas that have seen the most capital depreciation in the last 18 months, being the top 25%, is roaring back into numbers. You're seeing again, what are supposedly the bottoms of ranges being blown out by 30, 40%. So it's never easy to explain the property market as this one simple thing. And interest rates are one thing. The other thing that a lot of people are also telling me, which is very, very true, that those are savvy, it won't be forever, right?
Correct.
Interest rates at this current level, or the higher level they're going to go to that you and I are predicting in the next couple of months, will not be there in 2025. And they definitely won't be at that level in 2026 or 2027 because they can't be. The restrictiveness of it, the impact it's going to have on economic activity longer term is too hard. So they will move to the downside. And again, those that are savvy, those can look through the here and now, will see the opportunity that's starting to present again.
It's one of those stories that I've said so many times on this podcast, that during this time of fear and uncertainty, that's the time when you want to be looking at making your purchases, when you want to be buying. Because as soon as you get that injection of confidence back in, the market will then bounce back up again. So everybody that's sitting on the fence waiting for a 40 or 50% correction in Sydney
They'll miss.
or Melbourne,
they're
not going to get it. And you're right. There's many micro markets. It's too hard to say how everything's going to behave. Everything doesn't behave largely the same. Everything's completely different. And every single market has their own dynamics for reason why it's going to move. But what you said there is really important. We will see some rate rises. And I do think at a time, once we've seen how things are stabilized, there'll be some rate cuts again. And at that point, that's when we're going to see some buying activity.
So here's the thing I say to you, right? Do you believe that the RBA, or any central bank for that matter, is absolutely set in its ways for the next 6 to 12 months? Because I don't.
No.
So,
it's a little bit of dial this, wait and see. Dial that, wait and see. Is it cooked yet? Is it right?
Yeah. None of that. Like, I would argue that if they start to see inflation really moving down quite quickly, then that change will be rapidly impacted through what they do. right? So if they start to see the unemployment rate tick up to about 4.5%, and inflation move back into the low fives, touching into the fours in the next 6 months, their language and the way that they're communicating right now will be completely different to what is going on. And so if anybody's thinking that central banks are going, we are saying this is going to happen in 2025, I mean, they've just got burnt doing that by saying that we don't expect the data to allow us to increase rates till 2024. Be aware of my language I use there, because I want to say very clearly, they never actually said that they were rapidly going to lock in rates at 2024. I understand why the implied meaning was there. That implied problem is their communication issue. But it was, again, their term was, if the data demands it, we don't think rates are going to be able to move, because that's what we're being told, that the health issue and the health crisis from 2020 was going to be that. And see how fast they've changed. I mean, realistically, this time last year, they were still treading water on the idea that inflation was structural rather than transitory. They were still basically trying to fight away the idea that they need to rapidly raise rates. I mean, if you look at the consensus forecast, this time last year, the cash rate was supposed to be at 1.25%, not at 3.35%. So that's how fast it can change to the up, but also to the down. And that's why, if you are thinking here and now, you will get A, not only left behind, but B, you won't see the opportunity. And there is opportunity that's there. It's about being savvy. For me, it's about, doing the legwork. Right now is the legwork time. That is calling your lender, making sure you get a better rate. That is looking to control the controllables you have, looking to do better on all of your household fixed expenses that you can. That's where you can save. That's where you can fix and offset these issues around interest rate rises, and being nimble for when they do start to move, that you can do it. Or, as I agree with you, Dom, I think right now there is going to be opportunities in some markets that will come out of nowhere that are really, really quite attractive.
Can I ask you about your thoughts on the cliff? Because we've had many cliffs that people have spoken about for a couple of years.
Yeah.
The impending cliff of fixed interest rates coming off 2%, and then these borrowers landing at 5% or 6%. How much credence do you give that? And does that mean in April or May, we're going to have 20% discounts in the real estate market?
So I give credence to the impact. Like, it will certainly change behavior. Like, there is no doubt you can't have a $1,500, $2,000 increase in your monthly mortgage repayments and not have a change in behavior. So that's a given. Do I think it will create a cliff? No, I don't. Do I think it's more of a steep ramp? Yes. Do I think that the impact that will have on inflation will be much, much faster? Yes, I do. I think that's getting back to what we've just discussed, is those 880,000 people this year that are rolling off fixed rates onto variable rates and going from, 2s up to 4.5s, 5s, will change their behavior very quickly. It will take a lot of cash out of the market, take a lot of demand out of the market. Don't forget, inflation's a rolling 12-month rate, right? It's a rolling 12-month thing. And so, the price increase from February last year to February now, or what's going to be happening in April last year to April this year, is not like the years before where we had the COVID problems. We are now back into almost normal living from 2022 to start going through that inflation. So I give it credence. It will hurt. It is coming and it will change. The thing that I would argue is that people are already making behavior changes to adapt to it. So they know their mortgage is going to jump, and therefore they're putting, and you already alluded to it, Dom, you put it perfectly, the amount of buffer people have in offset accounts or cash accounts, whatever it might happen to be, overpayments in their mortgage, doesn't matter, whatever evaluation, that is going to get them through this. It's just that they're going to all of a sudden go from having this ability to save rapidly and quickly converting cash into an asset like property, to going back to the sort of a slightly more normalized scenario where, the cash to property transfer of principal is impacted by interest rates and interest by the interest they pay. If you look at it over a rate of turn, it probably normalizes. So that, again, I've just probably argued what the RBA is trying to argue, which is that they just don't know what people are going to do with those XX savings, because normally Australians aren't really savers. COVID has changed us from being a spending sort of community into a saving community. And the data is, and again, these is where those boffin problems come in, is that they don't really have the data to deal with this because it's not and hasn't been represented in our society for several generations. You've got to go back to the baby boomers and when they were more net savers than spenders to see that. And so that's why they say we don't know what people are going to do with it. Are they going to go out and spend this excess cash, or are they going to see it as just part of their overall savings and sit on it and not impact inflation? I would argue it's possibly moving towards the latter because, again, the back of the envelope or the cab question, sitting in the back of the cab and listening to the discussions, people are fully aware that their purchasing power is under attack, and that's probably the correct term. They're fully aware that the cost of what they're having to deal with over the next coming year is something like they haven't experienced before, and they're battening down the hatches. So that means to me, they want to keep that savings. That's how I read that. That's the behavior that they're exerting. They want to try and keep that savings as much as they can, and therefore they're not going to spend it.
Matt, I want to echo your sentiment. I'm going to make a small prediction. So my thoughts on the matter are similar to yours in that much of the people that led the buying frenzy through COVID were home buyers. It started with government grants, started with upgraders, first home buyers, and then it moved into home buyers. They led the charge on buying all of this property, upgrading their homes, and fixing their rates. Now, I can promise you to all the people listening out there, if you fix your interest rate at 2% on your $500 or $1 million mortgage, you know when it's going to be expiring. So as you've just said, these families, these units, these individuals are very well aware that their interest rates have increased, were going to increase, and they need to do what's necessary to either thrive and survive or, sell the property or do whatever they've got to do. So it's not going to be a surprise for them. So as you said, they're probably tightening up their expenses, removing 2 or 3 of their subscriptions, getting rid of Hulu or Netflix or whatever it's got to be, getting rid of the gym membership that they probably weren't using anyway. So tightening down the battens. And if they're looking at this property, maybe some of them are investors and they have come late they were early investors and they're looking at that investment. I think that they're less of a risk because investors have seen a huge amount of rental increases in their portfolio largely. And the other thing is, interest is a tax deductible expense. Running investment properties are traditionally less expensive than buying your own home. So that's why my gut is saying, listen, a lot of the issue people are going to be the ones that were homeowners, and homeowners are either going to cut back their spending, keep that savings available to them, or very early look to sell that property. I don't think it's going to be a cliff where there's going to be 800,000 people selling their properties.
Flooding the
market. Be a massive crash.
Yeah,
it's a ramp, as you said. I think it's going to accelerate deflation in the market.
Yeah, and that behavior change is I think not fully represented yet. Like all of the data that we're getting, unfortunately, is still retrospective. It's the end of last year. I mean, again, not trying to sort of parrot what's been said by the RBA or what have you, but the data we're getting at the moment is November and December. And that was, the first real period in the last 3 years of no impacts on restrictions, no impacts on the health requirements, no changes to travel requirements or anything like that. First full year within reason that was probably like 2019 rather than 2020 and 2021. And therefore, again, that's why my argument at the moment is we're going through that final part of the euphoria of coming out of COVID. And therefore the data is skewed, and you can hear that with what they're talking about. I mean, you look also the changes that we're now having around when we consume. November is now becoming the bigger sort of month for consumption in retail rather than December because of things like Black Friday, Cyber Monday, forward sales in November. So it's noisy, and that's why it's hard to sort of put to where it's going to be. And I'm right with you in that at the moment there is this belief that there's going to be this massive contraction in consumption, and we're going to have the hard landing or the soft landing. And the other one that we're now saying here is the no landing. The no landing is the interesting one because that idea is that basically we're going to have higher rates, higher inflation, but also higher growth. The plane's not going to land, and then it's going to run out of steam and go bang. And that's the rumors coming out of the perma bears out of the States. The hard landing is where you do have a protracted level of recession, higher level of unemployment because of interest rates. The soft landing is a scenario where we've tightened just enough to slow things down. We don't go into recession. There's a slight tick up in unemployment, but we get through slightly unscathed. Whatever you believe, it's not really a point. What is clear about everything that's been discussed is we just need to slow down. We need to understand that the last 3 years have been completely like nothing we've experienced for obvious reasons. It's a once in a generation health crisis. We've had a scenario where we now know that we only get to live once, and therefore we started to live like that. Our spending is still above pre-COVID levels when you look at the personal consumption expenditure stuff. That needs to slow down, and that's okay. That's okay. We're just basically normalizing across those 3 years. And I think that's how, at least how I look at things, is that they're just trying to slow down the last couple of years back into normality to get us back on an even keel that 25, 6, 7, 8, and up into 2030 are much more sustainable periods as we navigate out of what's been the most tumultuous periods of living memory for most people.
Evan, you've said a lot of really good, interesting facts there about the economy, about human behavior, buying psychology, and how the governments are trying to sort of help normalize our behavior. Let's talk about now your book, if that's okay.
Yes.
And the reason why I want to segue over to your book is because I feel like, without having read it, I've had a look at what it's all about, but I feel like there's a lot of helpful hints in there for people that are looking to learn better spending habits and get a control over their finances.
Yeah, I know. The reason I did it is, as you can hear when we've been talking about this, markets, economics, all that kind of stuff. It's just a study of what people do as a collective, right? So that's all economics is. Like, it's just a study of what the whole group of people is doing in one direction or another, which means it's behavior. And that's what I love. I mean, behavior is a fascinating thing, because my first question that I ask in the book is, what is money to you? Because I know that what money is to you, Dom, and money to me, although we're very similar in our personalities, it's going to be slightly different, all right? And so the book is all about getting you to just identify what money is to you, what you want your money to do. So for me, I want autonomy. I want the ability to do what I want, when I want, how I want. That's what my money is set up to do. That's how I look at it, which means I also talk about it from the point of view that money to me is just, inverted commas, potential in like electricity. In that, what I mean is that money gives me the potential to turn it in from a piece of money into an asset. And an asset can be anything. That's an experience. It can be a night out with your partner. It can be going overseas. It can be an asset to buy a home or an equity. It can be whatever you need it to be. That's the potential it gives you. And therefore, for me, money for me gives me the potential to do what I want when I want. So I want time. My thing with money is time. That's my behavior and the way I position myself. You'll be different, and that's great. And I talk about that in the book. It's also about understanding why, losing money is such an innately part of what we do in our behavior. So loss aversion is one of the strongest biases, as we call it, in finance. And it's something that we do all the time, fight or flight. But loss aversion, you are much more attuned and will be much more upset with losing $20 out of your pocket than making $50. You will fixate on the $20 loss for up to a week, the studies have found, whereas you'll probably get a euphoric kick out of that $50 for as much as a couple of hours. And that's the difference, is that getting through those psychological issues of, that protective mechanism that we have with loss aversion or confirmation bias, to talk about all these kinds of things. It's the reason I wrote the book is to get you to identify it, because the next step on that is that just identifying it isn't enough. It's about then creating a habit. It's about creating a financial habit that makes you a better investor or a better person with money, or a person that has the ability to actually act on opportunity. Because that means things like automation. That means things like using habits that you develop through, whatever, metaphor you want to use, whether it's, learning to run for a marathon, or whether it's to, get better at a foreign language. It doesn't matter. You've got to take that first step. So that's a habit change. And those habit changes are part and parcel with behavior. So all of that fits into it. I know that's a little bit weird for what we've just discussed, but that again is that once you start thinking about that, your ability to therefore be identify with money in a positive, consistent manner can increase. It also means that your ability is that what Dom and I just talked about before this discussion around investing in property or looking at markets in a more positive light can come to fruition in a better way. So that's what Mind Over Money was done for, and why I did it.
That's a really, really important topic, because I talk to brand new investors and homeowners all the time. And I meet a lot of people early in their journey, and it's the mental game that kicks everything off.
Absolutely.
There's so many people that I talk to, and I'll say, before you go buy a property, maybe go buy some shit. Go invest. Go and buy something, learn what it's like to do a little bit of research, take your $100 or $1,000, invest it into something and understand that feeling. The feeling of $1,000 leaving your bank account and putting it somewhere and monitoring it, and then starting to get an understanding of risk return. Just those simple money habits and getting your head around how money behaves is a fundamental thing that you should start with before you think, hey, I'm going to go and spend $1 million on this thing, because that can become really traumatic.
Yeah, because that's what I want to do. Because the other thing that I love sort of talking about this in another way is exactly that. The other thing about going and investing in a market like equities is that every day between 10 and 4 Eastern Sydney time it's open, right? So it has a price. The value of what $1,000 will move on you up or down. And, how do you deal with when it moves down? And the reason I say that is that the interesting thing about property is that, unlike equities that are listed on the ASX, that you can see the price of it every day for 6 or 7 hours a day, property doesn't do that. And the interesting thing about why I say that is that what fascinates me about people that are into property is that they forget that it does move up and down. And I always say, if you had a big neon sign on the top of your roof of your house that told you to the cent what your house was valued at, and you came home one day and it fell by 10%, what would you do? And why I say that is that thing that you just explained before, Dom, which is perfect to get those people to get accepting the movements of markets, is that thankfully property doesn't tell you that. But it also, you need to be aware that, yes, your $1 million could go from being $1 million to 990,000, or it could even go down to 950,000, and you've lost $50,000 in value. But it's uncrystallized. It's a long-term asset. It's an asset that has a return because you're probably going to get income from renting. It's the same with equities. You're going to get dividends and whatever else. That is the psychological problem you have to overcome. That is the behavioral finance thing that I love, of trying to get you through the emotion of what is realistically a very, very rational decision-making process, right? And humans aren't rational. We're reasonable. We make decisions constantly every day. We make about 35,000 decisions every day, and the majority of them we don't even realize we make, because we are reasonable. We know how to evaluate things very quickly. But when it comes to a very rational decision with irrational possibilities, that's where emotion takes over. That's where biases take over and behavior. And that's what you need to sort of identify, overcome with better habits, or things like automation that can get you away from hitting the sell button or panicking when your property does fall in a market like we've got right now.
Yeah, getting around your impulses when it comes to investing is one of the most critical things that you'll do as a sophisticated a sophisticated investor. Period. Where do people find you, Evan, and where do they find your book, and how do they get in touch with you?
So they can find me social media. So Instagram, Evan Lucas _, Twitter, Evan Lucas _INV, LinkedIn, just look at Evan Lucas. You can find my book in all good bookstores, Booktopia, Amazon online, or Dymocks, or you can find it at Readings, etc. But before we move on, let's talk about your book, because let's talk about your book, because I'm going to be polite and make sure I don't actually say it properly, but I'm going to say it. You won't F it up. What a brilliant title. What a brilliant story. What made you write it?
Thank you. Well, let's not beat around the bush. It's you won't fuck it up.
Yeah,
I won't be scared.
You can say that. Yeah.
No, the reason why I wrote the book is I've been in real estate for a very, very long time. I don't look that old, but I've been passionate about real estate since I was a kid. And the one thing that resonated with me is people are very scared about investing in real estate. But I learned that if you've just do the simple things well, you won't fuck it up. If you get in and you just think about it very rationally, and property's not it's very simple. It's much, much easier in my mind than equities and a lot of other things because there's so much emotion into buying property and it becomes a lot more predictable. It's also a home. It's not just a pure investment. It's a tangible asset. It's there. It pays a return. And it's longer, bigger market cycles that impact the value of it. So I like, in my book, I unpack, the bigger macroeconomic things like population. It's a big, slow moving beast, investments in infrastructure, big roads, airports, transport, that stuff impacts prices. Supply, all that kind of stuff is really important to understand in order to then see where a property market's going to go. But thank you for the segue, because what I've done on the podcast now is I've created a new segment, and it is You Won't Fuck It Up. And it's what piece of advice would you give to new investors or homeowners so that they don't fuck up their next purchase?
So my thing on that is, first and foremost, it's a little bit different. There's no right or wrong time, right? So if you are coming to this podcast and you're 20 or you're 70, today's like any other day, right? So if you're starting today at 20 or 70, congratulations, welcome. And I will agree with Dom, you're not going to screw it up, right? Your long-term view is there. The other thing to remember is anything that is less than 24 months in an investment thought process is noise, right? That is the big thing to remember. If you're buying a property to flick it in 24 months, then that is something you need to evaluate why. Because my argument, I know Dom's argument too, would be that's noise. You are getting caught up in short-term ideas. The final thing to remember, as Dominic pointed out, equities, property, and to some extent fixed income as well, whatever asset class you want to talk about, is going to, over the longer term, return you better than holding cash, right? Sitting on cash is getting eaten by inflation. And as we said at the start of this entire discussion, inflation is a killer. It's an absolute killer. And you have to try and beat it, right? Or tame it. So it means you need to be thinking the money that you have in cash is getting smaller every single year. The dollar today is not a dollar next year. It's going to be a dollar less inflation. And as I said, if we kept going at inflation right now, you'd need $1.40 in 5 years' time. It can't be done. So you have to think about how I'm going to beat inflation. And that means, unfortunately, taking some risk, but also, fortunately, you're not going to make the mistake. Because if you're investing in things, whether it's equities, whether it's property, it's a tangible asset for property that you can improve, that somebody wants to live in. An equity is a business, right? Don't forget, it's a business you're investing if you're doing BHP or CBA, or an ETF where you're investing in all 200 companies of the ASX 200. They are trying to improve. They're trying to grow. They're trying to get better. And they're going to pay you for that right, for giving them their money. So that's why I agree with you. You can't screw it up if you have a time frame of more than 2 years. I'd even argue 5 years. And as soon as you start thinking that time, you're going to beat inflation. You're going to be in a much better financial position than you will ever realize.
Really, really good advice. To summarize, whenever you start, it's a good time. There's no good time.
Yeah.
Anything less than 24 months is noise. You really want to be thinking about your investments over 5, 7, 10 years.
Yep.
Getting in and doing something is excellent because you want to be beating inflation. I think cash is a big killer. It is only potential, but that potential withers away if you leave it in your bank account. It's
correct.
A false sense of security. I've actually got a bit of a cash aversion. It's a problem. So I've just parked all of my cash into my fiance Charlotte's account so I can't see it. My bank account's basically zero now.
Sure.
And it makes me behave in a much better space. I'm less impatient. When I have money in my account, I feel the need to go and spend it. So now it's away from me.
And that's your personality. And again, I'm going to hype my book again. That is something I cover, right? Personalities are very different. There are spenders, there are investors, there are savers and whatever else. Some people have to see the money. Some people have to actually see that money in their account. And those savers, although they are never going to be in financial difficulty, they miss opportunity too, because they just sit and stare at it. And they need that security blanket of having physical cash sitting in their bank account. That's also has problems to it, and I completely agree with that. But if you know your personality, so Dom, obviously, if you can see money, you'll use it, maybe slightly detrimentally. That is also a positive step that you've made to move that issue that inside of you that you have. I'm a bit like you. If I'm out and about, I will go from being what I believe I am, which is probably a saver investor, into a spender like that, because I will happily go out and buy you, a night out because it's what I think is the right thing to do. And that's a problem. So I try and get away from that by making sure that I have limits on, the card that I have or what have you. That's another story. But again, perfect summary of just being aware of knowing who you are and knowing your good traits and also slightly your bad ones and using them to your advantage. Because your bad traits aren't just bad. They're not bad. They're just something that you may not find is, positively affecting your money longer term. Spending's not a problem. You don't want to die the richest person in the cemetery. There's nothing wrong with spending. It's just making sure that you've got control of it.
Mind Over Money. Really, really intrigued to get my hands on one of these books. Evan Lucas, I really appreciate you spending time with me today. Everybody, remember to go and follow Evan, buy one of his books. And after you have, this is my ask today. I want to hear what you think. Leave a comment, leave a review. If you've got questions for Evan, please leave them in the comments below. Mate, it's always very good catching up with you. Thank you for your time. I love your shirts, and we'll be catching up again shortly, I'm sure.
Thank you so much. And before I finish, don't forget Dom's book is out in early April. Go and get it. It's going to be brilliant. I know what he does. I've actually been lucky. I haven't told him this. I've been privy to actually read a couple of chapters because the publisher sent it to me. I've seen it. It's brilliant. Go and get it when it's out. You will not get it wrong. I'm not going to use this swear word because I'm on a public forum, but it is brilliant. You're not going to F it up. It's going to be a fantastic book, mate. Congratulations. And thank you for having me. As always, I really look forward to doing these, and I'll see you again soon.
See you later, everybody.